Hi ladies and gentlemen, this is Alvin from Dr. Wealth, and today I'm going to explain to you this corporate action called share consolidation, or in some countries like the US they call it reverse split. So let's go. And usually the announcement of such share consolidation will come in this kind of form, right? They will say that for every 2 shares, right, we will consolidate into 1 share. Okay, of course the numbers can differ. It can be 5 shares to 1 share, 10 shares to 1 share. It depends on how the management decide to do this share consolidation, but I'll just use this as an example. Okay, so first thing that you note is that the number of shares that's available in the market actually decreases. Okay, so if let's say the share price is trading at 50 cents, okay, after the consolidation the share price would actually goes to $1. Okay, so in other words, if let's say you own 2,000 shares, for example, after the share consolidation you'll become 1,000 shares, right? And which means previously your share is worth for 50 cents at 2,000 shares, it will be $1,000, right? And after the consolidation you have price it at $1 and you still have 1,000 shares, that gives you also $1,000. So the second thing to note is that your net worth, okay, or your investment value of the stocks that you're holding after a share consolidation does not change. All right. Of course, this is in simplistic theoretical calculation. Of course, sometimes the share price may vary away from the theoretical value of it. All right, but I just want to share with you that actually there is no change. Even though the number of shares decline, your investment value in that stock still remains the same. Okay, then in this case, why would some companies want to do a share consolidation or a reverse split? Usually the scenario is like this, right? The share price have not been doing well, it's been going down up till, it's very close to maybe a $0, right? It's very cheap, like a penny stock. Okay, and penny stock don't have a good reputation, and they want to improve the perception of their stock, so they do a share consolidation. As we can see, the share consolidation has this effect of increasing the price, right? So when after the consolidation is done, the share price will shoot up, right? Because there are less shares in the market, each share is worth more. Okay, but there's a tendency that after the consolidation, because fundamentally these are not so good stocks, okay, they may continue to have bad performances, and investors may continue to sell down the stock, right? So the share price has a tendency to go down again, and they may do another consolidation and on again, right? Which is not good for shareholders in general. Okay, it just, the share consolidation, you can just see it as it just create more room for the share price to go down even further, because if they're very close to $0, there's no chance for it to go below $0. It cannot be a negative value, right? So if once they do a share consolidation, there's a tendency for the share price to go down again, right? So usually not so good companies do share consolidation. And another thing to note, right, is that you can see that the number of shares goes down, okay, which will affect the liquidity as well, right? The liquidity, there's less shares being traded, okay, and it may increase the spread. Okay, that's the consequence. You increase the spread, okay, the bid-ask spread, right? As you know, when you buy a stock, there's always a bid-ask quotes. Okay, so this difference will just increase from there due to a lower liquidity. So that's another downside of share consolidation. All right, so in summary, share consolidation and reverse split are the same thing. They just use as different terms in different countries, and usually poor performing stocks do it because their share price have been going down so much. It creates a negative perception that they are penny stock, or the associated problem that comes with it. So they want to improve the perception, they do a share consolidation, and share price goes up. And it results to lower number of shares that's available, and that means the liquidity will go down, right? And higher value per share because there's less shares in the denominator, right? So per share value goes up. It's generally bad because it lowers liquidity, and that increases the spread, right? Like what I mentioned just now, right? Price spread. That means when you try to buy or sell, you need to incur more of these price spreads. You lose some of these price differences. Okay, when you buy, you have to buy cheap. When you buy, you have to buy higher, and then when you sell, you have to sell lower. Okay, so that is the impact. And then the share price has a tendency to go down thereafter because these are generally poor performing stocks in the first place. Share consolidation is not going to change the fortune of the company, right? It's just a very cosmetic way of increasing the share price, but the underlying fundamental business, if it's not doing well, it will continue to be lackluster. Okay, so I hope that I've given you a good explanation what share consolidation is and how, as an investor, you can interpret this better in the future. Thanks for watching.